Did you know that you could earn a steady income stream just by holding the right stocks in your portfolio? Imagine receiving regular payouts from your investments without having to sell a single share. Sounds intriguing, right? Well, today I'm going to show you exactly how to find those high dividend-paying stocks that can provide you with that consistent cash flow. A few years ago, I found myself stuck in a dead-end job, struggling to make ends meet. I knew I needed to find a way to make my money work for me, rather than the other way around. That's when I stumbled upon the concept of high dividend-paying stocks. I started investing and, over time, watched as those dividend checks started rolling in, providing me with a steady stream of income that changed my financial situation forever. Now you might be wondering, why should you care about high dividend-paying stocks? Well, let me tell you, understanding how to find these stocks can significantly boost your income and help you achieve financial independence. By strategically investing in these stocks, you can enjoy a reliable income without having to sell off your assets. On the flip side, ignoring this strategy could mean missing out on potential passive income streams that could help you reach your financial goals faster. If you want more tips on building wealth, hit the subscribe button. Your support helps us create more valuable content for you. Step 1. Research dividend yields. The first step in finding high dividend-paying stocks is to research dividend yields. But what exactly is a dividend yield? Simply put, it's a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. It's a key indicator of the income you can expect from your investment. The higher the yield, the more income you receive per dollar invested. For instance, imagine a company. Let's call it XYZ Corp. If XYZ Corp pays $5 in dividends per share each year, and the current share price is $100, the dividend yield is 5%. This means for every $100 you invest in XYZ Corp, you can expect to earn $5 annually in dividends. It's a straightforward way to gauge the return on your investment from dividends alone. However, it's important to remember that a high dividend yield isn't always a good thing. Sometimes, a very high yield can be a red flag. It might indicate that the company's stock price has dropped significantly due to underlying issues, and the high yield is unsustainable. For example, if XYZ Corporation's stock price falls to $50, but it still pays $5 in dividends, the yield jumps to 10%. While this might look attractive, it could signal financial trouble. So when researching dividend yields, look for companies with attractive but sustainable yields. Generally, a yield in the range of 2 to 5% is considered healthy, depending on the industry. Companies with yields in this range often strike a good balance between paying out income and retaining earnings for growth. Step 2. Look for consistent dividend payouts. The next critical step in finding high dividend-paying stocks is to look for companies with a history of consistent dividend payouts. Consistency is key here because it indicates reliability and stability. You want to invest in companies that have a track record of paying dividends regularly, year after year. Think of it like this. If a company has been paying and even increasing its dividends for the past 10, 20, or 30 years, it's a strong signal that it values its shareholders and is committed to returning value to them. This kind of track record also suggests that the company has a solid business model capable of generating steady profits, regardless of market conditions. Take Johnson & Johnson, for example. This company has been paying and increasing dividends for over 50 years. This kind of consistency demonstrates not just financial strength, but also a commitment to its investors. When you see a company with such a history, it's a good bet that it will continue to pay dividends in the future. But how do you find these companies? One way is to look at the Dividend Aristocrats list. These are companies in the S&P 500 that have increased their dividends for at least 25 consecutive years. Another source is the Dividend Kings list, which includes companies that have increased their dividends for 50 consecutive years. These lists are gold mines for finding reliable dividend payers. Consistency in dividend payments can help you build a predictable and stable income stream from your investments. It's like planting a tree that bears fruit every year without fail. Over time, these dividends can compound, providing you with a growing income stream that can support your financial goals. Step 3. Evaluate the payout ratio. The third step in finding high dividend-paying stocks is to evaluate the payout ratio. The payout ratio is the percentage of a company's earnings that it pays out as dividends to shareholders. This metric is crucial because it gives you insight into the sustainability of a company's dividend payments. Let's break it down with a simple example. Imagine a company, ABC Corp. If ABC Corp earns $10 per share annually and pays out $3 in dividends, its payout ratio is 30%. This means that the company is distributing 30% of its earnings to shareholders and retaining the remaining 70% for reinvestment and growth. A lower payout ratio generally indicates that a company has enough earnings to cover its dividend payments and still invest in its business. This is a good sign because it suggests that the dividend is sustainable even if the company's earnings fluctuate. For instance, a payout ratio below 60% is typically considered healthy across many industries. It shows that the company has a buffer to maintain its dividends during economic downturns or periods of lower earnings. On the other hand, a very high payout ratio can be a warning sign. If a company is paying out most of its earnings as dividends, it might not have enough left to reinvest in its business. This can lead to trouble down the road if the company faces financial challenges. For example, if ABC Corp had a payout ratio of 90%, it would mean the company is distributing almost all of its earnings, leaving little room for growth or to cushion against tough times. To evaluate the payout ratio effectively, look at the company's earnings history and future earnings projections. Consistently high earnings with a reasonable payout ratio indicate a company that can sustain its dividend payments. Additionally, compare the payout ratio with industry standards. Some industries, like utilities, tend to have higher payout ratios, while others, like tech companies, might have lower ratios due to higher reinvestment needs. By focusing on the payout ratio, you can identify companies that not only pay attractive dividends, but also have the financial strength to sustain those payments. It's like finding a balance between enjoying the fruits of your investment now and ensuring that the tree continues to grow and bear fruit in the future. Step 4. Analyze the company's financial health. The fourth step in finding high dividend-paying stocks is to analyze the company's financial health. A company's ability to pay and sustain dividends largely depends on its overall financial stability. Think of it this way: you wouldn't want to rely on a leaky faucet for your water supply. And similarly, you wouldn't want to rely on a financially unstable company for your dividend income. So, what should you look for when assessing a company's financial health? Start by examining the company's balance sheet. A strong balance sheet typically features low debt levels, healthy cash reserves, and a solid equity position. Companies with manageable debt are better equipped to weather economic downturns and continue paying dividends. For instance, Apple is known for its robust balance sheet. The company has significant cash reserves and relatively low debt, which gives it the flexibility to maintain and even increase its dividend payments. In contrast, a company with high debt levels and limited cash might struggle to sustain its dividends during tough times. Next, look at revenue and profit trends. Consistent or growing revenues and profits indicate a company that is successfully navigating its market and generating sufficient income to support dividend payments. Companies like Microsoft have shown steady revenue and profit growth over the years, making them reliable dividend payers. Profitability metrics such as return on equity, ROE, and return on assets, RROA, are also important. These metrics show how efficiently a company is using its equity and assets to generate profits. Higher values typically indicate a well-managed company with a strong ability to generate earnings, which can be used to pay dividends. Cash flow is another critical factor. Strong operating cash flow means the company is generating enough cash from its core business activities to cover dividend payments. Free cash flow, which is operating cash flow minus capital expenditures, is especially important because it shows the cash available to pay dividends after accounting for necessary investments in the business. Lastly, consider the company's dividend history. A company that has consistently paid and increased dividends over time demonstrates a commitment to returning value to shareholders and signals confidence in its future earnings. Procter & Gamble, for example, has a long history of paying and raising dividends, reflecting its strong financial health and shareholder-friendly policies. By thoroughly analyzing a company's financial health, you can identify those that are well-positioned to sustain and grow their dividend payments. It's like doing a health check on a potential business partner. You want to ensure they're fit and reliable for the long haul. Step 5. Diversify your dividend portfolio. The fifth and final step in finding high dividend-paying stocks is to diversify your dividend portfolio. Diversification is a crucial strategy to reduce risk and ensure a steady income stream from your investments. Think of it like a balanced diet. Relying on a single food group isn't healthy, and similarly, relying on a single stock or sector for dividends can be risky. So, how do you diversify effectively? Start by spreading your investments across different sectors. Each sector reacts differently to economic changes, and by diversifying, you can protect your portfolio from sector-specific downturns. For example, while technology stocks might offer high growth potential, they can also be volatile. Balancing them with more stable sectors like utilities or consumer staples can provide a more consistent income stream. Take a look at a diversified portfolio. You might include tech giants like Apple or Microsoft for their growth and dividends, healthcare companies like Johnson & Johnson for stability and consistent payouts, and utility companies like NextEra Energy for their reliable income. This mix can help cushion your portfolio against market fluctuations and provide a steady stream of dividends. Another way to diversify is by investing in different geographic regions. By including international stocks in your portfolio, you can benefit from growth in other markets and reduce the risk associated with any single country's economic conditions. For instance, adding European or Asian dividend-paying stocks can provide exposure to different economic cycles and opportunities. Diversification also means including different types of dividend-paying stocks. High-yield stocks can provide immediate income, while dividend growth stocks can offer increasing payouts over time. Balancing both types can help you achieve both short-term income and long-term growth. For example, you might hold high-yield stocks like AT&T for their attractive dividends and dividend growth stocks like Visa for their potential to increase payouts as the company grows. Moreover, consider using dividend-focused exchange-traded funds, ETFs, or mutual funds. These funds invest in a basket of dividend-paying stocks, providing instant diversification. Funds like the Vanguard Dividend Appreciation ETF or the iShares Select Dividend ETF can give you exposure to a wide range of high-quality dividend stocks without having to pick individual stocks yourself. Finally, regularly review and rebalance your portfolio to ensure it stays diversified. Market conditions change, and your portfolio needs to adapt accordingly. Rebalancing helps you maintain your desired asset allocation and ensures that no single investment becomes too large a part of your portfolio. To recap, finding high dividend-paying stocks involves a strategic approach. Researching dividend yields, looking for consistent payouts, evaluating payout ratios, analyzing financial health, and diversifying your portfolio. By following these steps, you can build a reliable income stream that supports your financial goals. Remember, the key is to invest in companies that not only offer attractive dividends, but also have the stability and financial strength to sustain those payments over the long term. With a well-diversified dividend portfolio, you can enjoy steady income and greater peace of mind regardless of market conditions. Now it's your turn. Start researching, analyzing, and diversifying your investments to secure a prosperous financial future. If you found this video helpful, don't forget to like, subscribe, and share it with others who might benefit. And let us know in the comments below. What's your favorite dividend-paying stock and why?